started. There's just basically we got a lot of questions from how much we put in super, and one of the biggest strategies we put in for year-end tax savings is putting money into super. A lot of questions kind of why we're doing it, how we can do it, how we can put the money out, which we couldn't answer because that's going to be a financial advice. So that's how Andrew come in, because for us to give advice on your super, we have to be lessons. But we work out that I think it's going to be better if Andrew and dedicated financial planner to get you understand the whole picture. So that's why we organized our first ever seminar. So today, that's very, very first one. So we just, for us to start it, we just, because me and Andrew been working on different cases for a few years, few cases now.
Yep.
So far we're pretty happy. We happy, client happy, then got very good results. So we're confident with the service from Andrew. So that's why we start from Andrew. So do you want to do anything before we start?
Sure.
Michael got an announcement before we start.
Hello everyone. Some of you may see me before, some of you may not. I'm quite new to leader accountancy. To put it simple, we recently adopted a system and a database which can enable us to assess your risk and do your business evaluation. So in your hands there are 2 pages. First page is like an executive summary of the first quarter's survey results, which can reflect kind of the risk issues among SMEs. On the back of the first page is a article to help you understand the relationship between risk assessment and your business evaluation. The second page at the front is a short business risk survey. If you can help me, to maybe take 2 minutes. It's just yes and no answer, and I put it in Chinese just to make it simple for you. And then I will be able to generate what we call it business risk survey scorecard. There's a sample attached at the back that I can send it to your email. And just please leave your name and your email address at the first page. Then that's it. Thanks, bro. I'll just hand it to Andrew.
Turn that on? That one?
Just all right. Just the right one.
Red one or green one?
Yeah, right. It's a mute. All right, thanks. Please welcome Andrew.
There we go. Welcome. Thanks for having me along. Tonight I want to do an overview for you about superannuation. Some of the slides are a bit wordy and a bit intense, but along the way, if you've got questions, concerns, just ask. This presentation had to go through my compliance area, so it's very formal, but if you want the other facts and how it all works, happy to kind of give you more information. So I'll get underway. As introduced, my name's Andrew Bird. I'm a financial planner. My business is called Summit Financial. I'm just across the hallway. So I've been in financial planning about 17 years, and before that, about 20 years in finance. So tonight, this is just general advice. So I'm not going to give you anything specific, so it's just general stuff. And we'll start off with the basics. There you go. I thought I'd lost all the fancy bits. It had been to compliance, and they took all the fancy bits out. So the basics of superannuation. Super is just a long-term savings plan. Okay, it's a piece of legislation that mandates that all employees will receive contributions to their super. What does it do? It enables us to accumulate funds for our retirement and to be able to provide us with income when we do retire. And that is aimed at being an alternate source of retirement income rather than relying on the age pension. So the superannuation legislation came into effect in 1992, and the aim was to take the burden of funding retirement away from the government cost, where they have to put money aside to pay the age pension and put it back onto each of us. So it's been in operation since 1992 and it's been accumulating along the way. So what are the benefits? That looked all right when I first put that on. It's getting a bit squirrely. So for employees, the benefit is that the employer pays about 9.5% of their wage into a super fund. That's legislated, it's required to be paid. Generally it's paid about every 3 months. So if you're an employee, if you're above the age of 18 and you're earning more than $450 per month, you will be eligible to receive super guarantee contributions. So that's casual, part-time, full-time, all required to be paid. What happens? So all that money gets put into superannuation funds and it's invested. The way it's invested is what I'll talk about later, but it should be up to you. Okay, it should be up to you. Most people do nothing, and it's just left in a default fund, or it's invested however it goes in, and that can be a mixture of shares, mixture of cash, mixture of bonds, and it's important to go and find out what that is so that you know what it's doing. And time frame. So superannuation is a long term. This is not 1 year, 2 years, 3 years. It's aimed for the long term. So for the first employee who comes on board when they first start working at 16, 17, 18, they will have accumulation of funds over their lifetime. As I often say to people, superannuation for most people under the age of 50 these days, this will be the largest amount or the largest asset they will have in their lifetime. It will grow to be their largest asset. Hang on. So, how do you access super? So really, because it's a retirement savings vehicle, the benefits of it are preserved, meaning you can't access it. It's not accessible until you reach a condition of release. Technically, there's one, you can reach age 65, but there's a couple of others. So you have to reach a preservation age, which is often, sometimes I'm asked, what's the retirement age? There is no retirement age, okay? But what you may be asking me is, what is my preservation age? When can I access my super to retire? And I'll show you, what's that here? So access is basically when you reach preservation age, are permanently retired, or you've reached age 65. So preservation ages have got a multiple effect. So the main one happening these days is if you're under the age of 54, it's 60. All right. Anyone younger than older than 54, it started off as accessing at 55. Then it moves up through the boundaries through those years. I think I've got a year and I can access mine. So. And these are key dates and important dates for when the accountants and when myself is looking at someone's planning and strategizing for what they want to do in retirement. Okay. So this is retirement age. Okay, if you want to retire and access super, this is the age. This is the dates. Okay. So what are the conditions of accessing? So the conditions of release, as I said before, it's either retirement or after you've reached your preservation age. So potentially you can access from age 60, or if you're a bit older, earlier. Age 65, the way I like to describe it is, for most people, what you've heard about super is it's all locked up, you can't access it. As you get to 55, the lock on the front door is unlocked, okay? And the older you get, door's unlocked and the doors are open. Because effectively, once you reach age 65, you have full access to your super. If you want to pull it all out, you can pull it all out, okay? If you want to put it in cash, you can put it in cash. If you want to do whatever, you can do whatever. Age 65, there are no restrictions, because all the laws, all the legislation around superannuation is all aimed at reaching this point. It's all about accumulating funds so that when you leave the workforce, you have funds available to fund your retirement life. The other ways you can access your super: you can die, not the best option, okay? Permanent incapacity. So if someone is injured and is unable to ever work again, then they can access super. And terminal medical conditions. So if you're diagnosed with a terminal illness and have 24 months to live, they'll let you access your super. Again, not a best option, but it's available. Okay, we'll start talking about putting money in. So for employees, currently the rate of contribution is required is 9.5% of their wage. So that's in part of the industrial war, it's legislated. The ATO is now cracking down on employers who don't pay it. And it's important that it's paid. It's part of, the original concept was, instead of receiving pay increases during the late 80s, early 90s, in exchange for improved productivity, workers would receive this contribution to their super. So this is part of someone's wage, it's just not paid to them in cash, it's paid into their super. I think the last, not the last budget, the budget before last, they brought out, or they're trying to extend out, there's a concept out there in legislation world, they want to push super contributions up to 12%. That's seen as being probably preferable of how much is needed to be put aside to accumulate enough funds so that people can live a full and active life in retirement. So legislation-wise, it gets thrown around by the various political parties, and at the moment it's legislated that from 2021-2022 the rate will go up to 10%, and then will go up by 0.5% each year up to 2025, and then it'll be 12% from then on. Okay? That may or may not occur. That's purely a Canberra thing. All bets are off. Okay, who can contribute? How can you contribute? What can we do? In simple terms, if you are under the age of 65, your employer can make contributions, so that's the SG compartment, superannuation guarantee. You can also salary sacrifice. So salary sacrifice is the option of paying extra into your super pre-tax. All right, so if you're an employee, you can go to your employer and say, I'd like to make an extra $20 per week into my super, and I'd like to have that coming out pre-tax. So it's a very tax-effective way of paying extra into super. I'll jump ahead in a sec, but effectively the maximum you can contribute is about $25,000 a year. That includes your superannuation guarantee. You can make personal contributions and you can make spouse contributions, and I'll describe those again shortly. Once you get over 65, they start turning the screws on what you can or can't contribute. You can still have employee contributions as long as you are working, so you can be 137. As long as you are working for an employer and they're paying you a wage, then you can receive superannuation guarantee contributions into your super. Okay? Where they stop allowing you making extra into your super is over the age of 65, which I think talked about last Tuesday night. I think we've just changed that. It comes from the budget. But effectively, there's a work test where they want to make sure that you have been working for at least 40 hours in the last 30 days. You can make your extra contributions. That's being adjusted in the budget. And it starts getting even more restrictive up to 70, 74. So what this means is, if you're looking to get money into super, and I'll talk more about why you should be putting it in, because effectively, when you're pulling that money out, it's going to be tax-free. You need to be doing it well before age 65, because there's limits on what we can do, and you need to build up and get the money there in time. All right. Happy to answer questions on that. There's no exam on this later, but
Excuse me. If you have not an employee, it's like a contractor, and they are over 70, do you continually giving them super or?
I would think, depends. I think the ATO would treat a contractor as an employee sometimes. I would take that question on advisement. That's a good question. Technically no, because he's not an employee, but because he's not being paid a wage,
No.
because he's a contractor,
Yeah, we pay you by the tax invoice.
I would say no, he can't. You don't have to pay him SG,
No.
potentially.
Um,
But I would refer that to the ATO. That's a difficult one, because it's when we start getting over the age 65, questions on who can contribute, how much can contribute, what's required. It's a case of looking at the circumstances and just being absolutely certain. But the law says if they are an employee, so if it's under an industrial award, they can be, but you're not required to.
Sometimes it's tricky to, how to regard the contract as an employee or not, right? In some specific scenarios.
I know more in recent times the ATO is cracking down on contractors. So most employers are being told if they're contracting, you still have to pay SGC. Yeah. That's what I'm seeing out in the mines.
What I mean by contractor is they are not only working for one place, they're working on maybe 2 or 3 places. Because our one maybe only one of these working places.
Self-employed,
Yeah.
no SGC.
No NTC, right? Yeah. Thank you.
Yeah. And I didn't say that. It was general advice.
Okay.
All right. What can you contribute? How can you contribute? All right. 2 ways: concessional, non-concessional. Tax deductible, not tax deductible. All right. So concessional means tax is going to be paid on the contributions. So concessional contributions are the maximum you can pay into your super accounts each financial year is $25,000. Okay. So if you are an employee and your employer is paying super contributions for you, and they might pay $10,000 per year to super, you can only contribute a further $15,000 via salary sacrifice. Okay, so the total is $25,000. If you contribute more than $25,000, there's excess contributions tax, which is not as harsh as it used to be, but effectively you'll pay your marginal tax rate on that contribution. So $25,000 is the key there. So what I was saying before is, if you leave it to really late to try and put money to super, you're restricted, because at this stage it's $25,000. In coming years, that will increase with the consumer price index and will potentially go up to 30 as it goes. But 25,000 is the key on here. Non-concessional, we're going to talk a little bit more about. So non-concessional is if you want to boost your super contributions and you've got a bit of cash lying around, 100,000 here and there, you can make non-concessional contributions to your superannuation up to $100,000 per year. Okay. When it goes into your super fund, there's no tax deducted from that contribution. Okay. I've got a few clients who work over in the Middle East, and so they're not paying tax on their income, so they're very tax focused. So my discussion with them is always, you're getting paid tax free, you can pay it into your super tax free, and when you retire at age 60 you can pull it out tax free. So why wouldn't you be using super to accumulate funds? So non-concessional contributions is a way that you can, if you win lotto or you have other bits and pieces, you sold an asset and you've got funds and you wanted to boost how much is in your super, non-concessional is the way to go. The 100,000 limit, I'll roll forward. So the $100,000 limit, we are also allowed to bring forward 3 years contributions. So if you came to me today and said, Andrew, I'm wanting to retire, we want to boost up how much money we've got in our super, what can we do? Because we are 32 days from the end of the financial year, I'd be saying, let's make a $100,000 contribution now before the 30th of June, which is your maximum you can contribute this financial year. And then on the 1st of July, we'll pull all the money out of your bank account, so the other 300,000 you've got sitting in there, and we bring forward 3 years contributions, and we'll put that in on the 1st of July. So you would be able to get $400,000 into your super, and then you can go and retire. So what we're saying is you can only put an extra $100,000 a year, each year, but if we use the bring forward rule, we can bring 3 years contributions forward. I've got a couple of people I'm working with at the moment where they've got plans in the next 3-4 years. So we've done money this year, we've done the bring forward, and we're waiting for, I think it's 2019 when they can do some more. So we're planning over a space of 5 or 10 years where we can get as much money into their super so we can build up their super, so ultimately they'll be able to draw tax-free income. Okay. So this is all about planning to try and get as much in as possible. So if you decide, oh yeah, I've sold my business, I've sold some properties and I've got $1 million I want to put into super, can't. Not in one lump sum. We've got to find ways of doing it to boost it up as quickly as possible. How else can you put some money into super? Who likes getting money from the government for free? Yeah? Excellent. Here, the best investment return there is, the government co-contribution. If your income is less than $36,813, and if it's not, just go and see Jerry and Kristen, sort that out. So if your income is less than $36,813, if you make a contribution to your super fund, the government will match half of it, okay, up to a limit. So if you put $1,000 in to your super, the government will give you $500.
So this is only yourself, it's not an employee.
No. Personal contribution. So these are personal contributions we're making. Not, I've stopped talking about employers. This is personal contributions. So if your taxable income says that you earn less than $36,813 this financial year, or if you think you're going to earn less than that, pay $1,000 now into your super fund, because you'll get an automatic return of $500 from the government.
Is that including all the you make rent, like you are a parent, you don't have that much income, or then just chucking it
as long as they are under 65,
yep,
and have taxable income.
yeah.
Yes.
Taxable income. So the income couldn't be zero, right?
It has to be. It can't be just from rental. They have to be working.
Oh.
Oh,
It's like
salary,
some,
wage.
Yeah.
yeah, if like some students, they might, 20,000 a year for the income, So if they pay some, and government will pay the half of it. Okay. Thank
My
you.
son might be getting a contribution to his super.
Oh, so
in the next
I'm
month.
thinking my daughter should get that.
No.
Yeah.
So
You already lost one.
Yeah.
yeah, it's a great kickstart for kids.
Mm.
I did one for my daughter, and now I'll do one for my son where we'll tip some money into their super, and they'll get a co-contribution. So I won't give them $1,000. That's it's not that good. But yeah, so for every dollar that you put in as a co-contribution, as long as your income is less than $36,813, you get 50 cents in the dollar. Now, you can still get a government co-contribution if your income is up to $51,813. And all that happens is that co-contribution reduces by about 33 cents. So if you put in $1,000 and your income was 51, I think you get $20 as a co-contribution. But it's still money for jam. Government.
Does trust distribution count as income, salary?
Are they working?
No.
I believe no.
Distribution income is more like a passive.
Yeah.
So
Yeah.
it's actually-
Passive income, no. So if it's just from a rental property or if it's trust distribution, no. It's got to be physical labour. It's got to be earned income. Yeah.
What if someone work for their own company? They got the salary.
Paid wages?
Yeah. paid
Yep.
wages. So,
Tick.
yeah.
Yep. So that's anyone who walk in, what's the wife earn, what's the husband, what the kids earn, co-contribution, make a payment now, get the money in there, money for jam. The other one's there is a spouse contribution. So obviously you've got to be married or have a dependent, a relation. So it can be same-sex, can be whatever. So as long as it's considered spouse. If you make a contribution to your spouse's superannuation fund, what happens is that it goes into the super fund and we designate what kind of payment it is, whether it's a voluntary payment, whether it's salary sacrifice. In this case, it's classed as a spouse contribution. And what happens is you get the payor gets 18% as a tax rebate. Okay? See those accountants at the back rubbing their hands for rebates. They love rebates. So, in effect, you could, if you're trying to, so over a space of time, husband and wife's on lower income or no income. So in this case, as long as the spouse is earning less than $40,000, and that's a recent increase. It used to only be about $10,400. So it's in the last 12 months, it's gone up to $40,000. So if your spouse is earning less than $40,000, if you pay a contribution into your spouse's super fund of up to $3,000, effectively you get a $540 rebate on your tax. So it's not refund, but a nice rebate that will reduce the tax you pay. Good tax planning. So simple things. These two are really, really simple things that you can implement now if you've got a spouse or one of your children is there, they want to do stuff. It's a good way of just boosting super contributions. But the non-concessional contribution, the key there is all about planning for when you want to retire and when you want to get money in. Because it's often the case, someone says, oh yeah, I'm going to retire next year, I'm going to sell this asset, and I want to put it in super. It used to be okay because we had higher limits, but now they've reduced the limits and you have to be very, very strategic of how you manage to get all that, as much funds in as possible. Okay, some of the wild, exciting things that are coming out at the moment. So last year's budget, they brought out this first homebuyer super saver scheme. I'm not yet sure whether I'm a big fan of it, but it can work. effectively what it's allowing you to do is for first home buyers, so for young people who don't have a house, even for older people who haven't bought a house, you are able to make contributions to your super and then pull them out to be used for your first home deposit. Okay? So it kind of goes against the grain of what I believe in super is, but it's an option. So it's only just come into effect, and as of 1st of July, so in 30 odd days, the first lot will be able to start withdrawing their money from super. How does it work? Well, it's not all as exciting as you think. So you have to be over 18. You have to have never owned a property in Australia, whether it's a home or an investment property. You need to intend to live in the property for at least 6 months of the first 12 months of the purchase, and you can't have used the scheme before. Now, you can't use your SGC, you can't use your employer contributions in this. It's only additional contributions, so you have to salary sacrifice to get it, or your spouse contributions. I'm talking to a couple of young nurses at the moment, and they're looking at potentially doing this where they're living at home, saving heaps of money, and they say, how do I go about doing this? So effectively what they can do is they can salary sacrifice a large sum of their wage into super. So it's going in pre-tax, so it's saving them tax in that manner on their wages, going into super. It is tax going into super, all right? It's taxed at 15%. How much can they use for this scheme? So they're only able to put in up to $15,000 per year, and it's a maximum of $30,000 that they can pull out. So it's, yeah, I agree, Mog, it's not much. So 30%, 30,000, 10% of a $30,000 home, plus costs, you've got to have other funds lurking around type thing. So it's an option for someone who may want to do it. It's better if there's two of you. Yeah. So husband and wife, boyfriend, girlfriend, boyfriend, whatever, because that you've got 60,000, a maximum of 60,000, and then we're starting to do stuff. We can get into technical details. It goes into a separate account in the fund. You don't get the earnings on the normal investment, but anyway, it's an opportunity, and it's a way of, if you've got family, if you've got friends who are interested in it, there's an option there. And any super fund does it. So it doesn't have to be a separate account or whatever, it just goes into normal super.
What happens if they decided not to buy the first home and they want to withdraw the money? Can they do that?
No.
No, I think you only realize when you do the settlement. You only realize the settlement.
Yeah.
Same as the first homeowner grant at the moment. So you won't get the fund in advance, so it will take place at settlement.
Yeah,
So it goes straight to.
save up for the first
You have to give notification.
Yeah.
And it takes months.
Some time to process it.
Mm.
Just with that, so have they taken away the brand new house condition? Because at the moment, the first homeowner.
No. So this is completely separate from first homeowner grant.
So
So
this is on top of it.
yeah, this is first homeowner grant is a state-based
Yes.
incentive,
Yeah.
and there's its rules and regulations. This is simply the federal politicians pandering to the masses and saying, well, this is mainly for the Sydney and Melbourne market, saying
Yes.
we can't afford a first home, well, how about we use super? So there's no first home owner type of house, it just has to be your first home,
Yeah.
and you're able to use it.
Okay.
Yeah. Downsizes. So at the other end, instead of at the first, it's at the back end. So if you're over 65, so from 1st of July this year, if you're over 65 and you sell your home, so mum and dad have got a large home, too big, kids have moved out, worth $1 million, what can you do? If you sell your home, you can now put some of that money into your super. So it's, again, it's for the Sydney Melbourne market, or that's where it's kind of coming from, where mum and dad have got a large asset, i.e. their home, but they've got nothing to retire on. So, and the benefit is we want to put money into super, but they haven't got income to put in. So in this case, what they're saying is, if you sell your home, you'll be able to make a contribution of up to $300,000 per person. So in effect, husband and wife, maximum $600,000 can go in, and $600,000 in super, nice little sum for a couple to have a form of income to live off. Who's eligible? All right, this is where it starts getting tricky. So your super balance must be below 1.6 million to be able to do it. And pretty sure you have to have owned the property for 10 years. Go back up. No, haven't got on there. So there's a couple of restrictions on it. But the option is there that, yep, if you're looking to sell your house to boost the level of funds in super so that you don't have to live off the age pension, you want to get some tax-free income, then here's a way of parking some extra funds up to, say, 600,000 extra into super. And this is over and above those caps that I talked about, those contribution caps. So if you come to me and you tell me you've got $1 million from the sale of your property and you want to get into super because you've just sold your house, I now have a plan. Right? So we've got 600 here. If there's a couple, 100 each this month, so there's 800. And next month we get the other 200 in. There's your $1 million straight in. Thanks very much.
Does they have a time frame to put money in after you sell the house? Or?
Don't think so. I can confirm that for you. It only starts next month. Yeah. So these are more and more options of how to get money to super. All right, we'll move on to everyone's favourite topic. Self-managed super funds. All right, love them and hate them. So self-managed super funds are out there, SMSF. Basically do it yourself. So there's a range of superannuation funds out there in the marketplace. You've got the industry funds that do their ad, we look after you, we've got low fees. You've got retail funds provided by every bank and every fund manager that's out there. They've all got their benefits, they've all got their non-benefits. So it comes to some point someone says, you know what, I really would like to have control over my own money. And that's where self-managed super funds come in. It's all about control, it's all about the flexibility of what you want to do. So a self-managed super fund is a trust, so it's held money in trust. It's held on behalf of, was for individuals. Under this year's budget, they're now increasing it so you now can have up to 6 members in a self-managed super fund. So quite often it's going to be yourself and your partner, or it could be your family, it could have 4 members of the family. Now it's going to allow you to push out to 6 members. So you can really start putting big money into self-managed to build that up. How much do you need to start a self-managed super fund? The ATO recommends a minimum of 250,000. I think my licensee highly strongly recommends that I do a minimum of 200,000. And anything less than that, we need to be able to prove that you're going to be putting a lot of money into that to make it worthwhile. Because there's costs. There's costs in setting up, there's costs in running it. There's a cost in running every super fund. It's just with your self-managed, it's more evident because you're paying it and you're seeing it being paid. Let me put it down. So what are the benefits? Level of control. You control it. Right? In its simplest terms, a self-managed super fund, once we've set up the structure, is a bank account. So your money's sitting in a bank account in cash, and you can decide where it's going to go. I think there's $2 billion sitting in self-managed super funds, and about 87% of that sitting in cash, because no one's doing anything with them, but we have a plan for that anyway. What else it does? It gives you the choice and flexibility. So usually the argument we hear coming from people with a retail fund or an industry fund is, I can't invest it the way I want to invest. I want to do this, I want to do that. And the big things that usually come out is people want to invest in shares, directly in shares. So they want to choose the shares themselves. In years gone by, you couldn't really do it in an industry fund or a retail fund. That's changed a lot. There's a lot more flexibility now to be able to do direct shares in the retail funds. So that's where you always went to self-managed. And with a self-managed, yeah, effectively you can put your shares trading account inside and you can buy and sell whichever shares you like. Good and bad. Good stories, I can show you my super fund. Bad stories, I can show you some clients who decided to go share trading and their balance went. So it's all about understanding what you're doing. Yep, we can open up a self-managed super fund and you can share trade and think you're going well, but if you're buying bad shares, you're making your own bad decisions because you're the trustee. You're making the decisions. Other things you can do, you can invest in investments not usually available to the public super fund. There's certain restrictions on there, but these days the most common form of investment we put inside a self-managed super fund is property. So if you want to own a house, your super fund can buy a house. If you want to buy an office, so if your business wants to own your business premises, mine is owned by my self-managed super fund, so I pay myself rent. And if the government tightens those, we're taking that, I can't tell you that one. So if the government tightens the contributions, we just increase the rent, okay? Bit of an extra. Commercial rent.
Don't worry, I can't do smart.
So yeah, if you're running a business and you're sick of paying rent to a landlord, or you think you could see some value in owning an industrial shed or a warehouse or whatever, a shop, then effectively it's possible for your self-managed super fund to own that and for you to pay rent, which pays off loans or pays for it. So you can hold the property inside a self-managed super fund. Some other wild and wonderful things: wine, painting, artwork, gold, physical gold or physical commodities can be done. But there's restrictions on that. So if you've got a nice Brett Whiteley painting that your super fund has bought, you can't have it in your home or in your office. It's got to be held externally. So you can't get to have the benefit of it, because the super fund is there for the benefit of your retirement. And if you're getting it now, you're not getting a benefit of retirement. So yeah, a few restrictions. If I sound a bit negative on self-managed, I'm probably turning that way because there's a lot of work, okay? You are the trustee. You are legally accountable for managing that fund. We will recommend that you outsource everything, okay? So you outsource the accounting, you outsource the administration, you outsource the investment, but still the documents come to you, okay? You sign off. If the ATO comes knocking, because the ATO supervises self-managed super funds, you're responsible, not me. You. The sole purpose test, we keep reminding people it's about your retirement benefits. It's not about today, it's about building money for the future. So, as I said, there's restrictive rules on investing in personal use assets and collectibles. And the assets of the super fund need to be kept separate. What's happened in the past is things get a bit tight in the business, and you're looking at the business account, and there's no money in the business account, and over in the self-managed super fund, there's 100, 200,000 in cash. Just slip that over. Can't do that. There are civil and criminal penalties if you contravene. So if you borrow from your super fund, you'll be penalised. I think it's up to about 250,000 and 5 years in jail. So it's a bit like you go into jail and there's a big guy sitting next to you and he says, "What are you in for?" He's in for murder, and I'm in for pension money from my self-managed super fund. So look, very flexible, great for purpose. To me, the main use of self-managed these days is property style stuff. Look, some key components. You can buy a residential house, and if you want an investment property, you can buy it inside your super fund. We can go to the banks and you can borrow money and do that. Restrictions. Can't have a family in there. No family. Okay? This is what we call arm's length. So it has to be a pure commercial transaction. So it's an investment property, you put in tenants that you don't know, and you should have a real estate agent looking after it. Okay? The downside of putting a property in there, it's lumpy. It's one big asset. So if you're heading towards retirement, I don't believe you should. Personally, I don't believe you should have property in super when you're in retirement, because when you need money, you've got to sell that house. All right? It's all right if you've got 10, 15 years and you're ready for it to grow, it's fine, it works. But if we get into the nitty-gritty of self-managed and buying property, there's the super rules. If you're going to borrow, then there's the bank rules. And the bank rules are harder than the super rules. All right? But we can talk about that. All right, my favourite topic. Self-employed. The worst people for superannuation contributions, the self-employed. All right. My standard conversation with someone who's self-employed, and they usually tell me, no, I haven't got any super, I don't contribute to super, I'm too busy, I haven't got enough money, blah, blah, blah. First line, do you pay tax? Yeah. Why? So, comes tax time. You've got to write a cheque. You've got to write a cheque to the ATO, no matter what. Goes to the ATO. Do you get that back? No. What if we write a cheque to our super fund? Do you get that back? Yes, you do. So, which is the better option? Writing it to the ATO and not getting it back, or writing it to your super fund and getting it back? All right. Not as simple as that, but essentially your contributions to super are 100% tax deductible. Okay? So if you've been paying tax and not paying super, then you need to have a discussion with your accountants about why you should be paying your contributions to super. You can make up to $25,000 per year. So that will reduce your taxable income and put some of your hard-earned money into a super account, which is there for you to make and grow and build and be there for the future. When I really break it down to simple stuff, when I'm talking to the tradies, I say, whatever you earn on a Tuesday, whatever you earn on Tuesday, pay into super. Because if you don't make it a regular habit of paying into your super, you never do it. You get to this time of year, and it's, I need to pay $5,000, $10,000, $20,000 to super. I haven't got it. So you need to pay it every month. Pay a little bit, build and grow. My recommendation is this time of year, you need to be meeting with these accountants at the back of your room and having a discussion, if you're self-employed, and saying, what is my tax liability going to be this year? How's my business gone? What should I be doing? And if you're going to be paying tax and you haven't paid super fund. Smart. Pay the super, then you've got money to go. Probably go back to the start. And it's usually, people have concerns about super. So let's break it down simply. Superannuation is not an investment. Superannuation is a piece of law that says if you make payments into a regulated fund and you save and build up, when you retire, you can take that money out. Okay? So when you move into retirement, if you're over age 60, over age 65, and you leave the workforce, you want to retire, and you want to live on something. If you are over the age of 60 and have retired, the money you withdraw from superannuation is tax-free. Okay? You get a choice. No, Andrew, I want to leave it in the bank. Leaving in the bank, you pay tax. Put in the super is tax-free. Andrew, I can put it in cash in the bank. You can put it in cash in super. Okay? Most super funds these days are very, very flexible and have a range of investments. If you fervently believe you only want to leave your money in cash, and I have got a big stick that I can hit you with for doing that, all right, you can. So you can leave it in a cash account. You can even put it into term deposits inside super. So whatever fund, it could be Oz Super, it could be Q Super, it could be MLC, it could be whatever. They have options that you can have in cash. So if you leave it outside super, you're going to pay tax. If you're over the age of 60 and you retired and you want to generate income, you can pull out lump sums, or we can set up a regular monthly income stream every month, hits your bank account, end on every month, same amount, keeps hitting the account, tax free. Your choice. Pay the tax, use super.
Sorry, the income you already got after tax, but why you have to pay tax again? You put in your
Which part? Sorry?
Are you talking about the cash in your account?
So,
Like in my account. Like after.
so if you've got money sitting in the bank now,
Yeah.
if you earn interest,
Mm-hmm.
you pay tax on that.
Yeah.
Yeah?
Yeah.
Not in super. Not if you're retired, tax free.
Because interest earned is your income.
Yeah,
Oh.
interest earned
Your
is income.
taxable income.
Oh, okay.
So if you have 100K in the bank,
Mm-hmm.
you earn in, let's say, 1,000
Mm-hmm.
as income, you need to fork out, depends on your tax bracket, you might fork out 200 or 300 for that 1,000 you earn. So you're not earning 1,000 because you need to fork out tax out of it.
I see.
Yeah.
Thank you.
Many super funds, variety of super funds. One of them will suit you. Is one better than the other? Don't know. It comes down to your personal needs, what you're looking for, what fees you want to pay, how you want to invest it, how long you've got, all sorts of things. So super is not, I always describe super, or usually the question is, what's the best super fund? Can't tell you. What's important about super is how it's invested. So the analogy I often used is, say, like a motor car. We've got Audis, Mercedes, Toyotas, Kias, Mazdas, range of cars you can buy. Which is the best car? The red one, obviously. Yeah. If we're going to take that car and go on a long journey, what's important is we need to make it service. We make sure it's running properly. Okay? So if we're going on a long journey, we take it down to the service station and we get it tuned to make sure it's running properly, like your super. You've got a long journey, you've got to make sure it's running properly. So the important thing is what's in your super fund, how it's invested, is invested the way you want it to run over that period of time. If you take your super or you take your motor car and you want to go racing, if you want to go out to Willowbank and go racing, then we need to tune our motor car a different way. We need to take that down to Wayne Park Auto and get it revved up and go really hard. Same, if you want your super fund to run at the highest level, really, really fast and high returns, then we need to invest it different ways. So how it's invested is up to you. Get advice. My job is to say, hear what you're saying, hear what you want to do, this is how you should invest it. Okay? Questions. I can talk for ages on super. Super's my favourite topic. You mightn't have noticed. Okay? Why is it my favourite topic? Many thousands of years ago when I started work, my grandfather was retiring from the education department, and he got paid superannuation. He got paid a lump sum, and I think it was $60,000, huge amounts in those days. $60,000 could buy you a house in inner Brisbane. And I always remembered that. And I started working for a bank, and they offered superannuation. I said, yeah, I'll take that. And we started contributing extra. Now, over the course of my working life, I've done good things and bad things with my super. At a young age, I may have done the wrong things. But all the time, I've always made sure I've contributed. And contributing to super is all about the long term. So for younger people, they don't understand the concept of super because it's 40 years away. But think of the snowball. The choice of contributing to super at a young age is, oh, should I contribute to the super or should I save for my home? You know, what's the best, you know? I say contribute a small amount at the start. You know, if they're 18, pay an extra $20, $30 and allow that to grow. They're not going to miss $20 or $30 a week. Right? They spill that on a Friday night. So that 20 or 30 accumulates and grows, and we get 2 years, 3 years, 5 years, 10 years down the track, and that amount grows and grows and grows. We all go through our various stages in life. So early on, they can put a little bit extra in the same time they might be saving for their house or for a car or doing whatever. In the middle stages of life, you've got kids, you've got mortgages, you've got school fees. So you still may not be able to make extra in, but you might be earning a higher wage, so you've got your contributions going in. If you're self-employed, make sure you're putting it in, all right? I'll come and see you. Make sure you're putting it in. And then as we get older and we start, the kind of gates are sitting there and saying, well, the key's in there and I want to get to my super, we need to start thinking about how we get it in and how often we get in. So we probably need to start increasing our contributions. But starting early and starting small and making a little bit extra will allow that to grow over time. Yeah. Questions? Concerns? Arguments?
If we work under like a self-management super fund, like who should we talk to? What expert should I talk to?
Start with your accountants, and they can talk to me as well.
Yes.
Combination. So it's like to set up a self-managed. The starting point is one is the right suggestion. Is it right for you? A super fund needs to be set up. So there's trusts, things that need to be set up, and then the next stage on from there is how's it going to run, how's it going to be invested. So a self-managed super fund needs to have a tax return done every year. Okay. All super funds have tax returns done. The retail funds, you just don't see it. It's done behind the scene. So the fees and charges that are done because there's tax returns being done behind the scene. But under self-managed, you as the trustee are required to ensure that your super fund has a tax return done and is audited every year. So talk to Jerry and the team about getting that organised and getting it through. And those minimum amounts, whilst you might be thinking, oh, I mightn't have that much in super, but as your partner, your girlfriend, your best friend's uncle's dog's friend, you can put 6 in there now,
Yes.
all right?
Yeah.
That's not started yet, right? It's 6 people.
Well, it's got to get through, it's got to get through Parliament,
Yeah.
so it may not.
But 4 people.
But 4 people.
Yeah.
So four people, you might have 4 people with 50,000 each, there's 200,000.
They don't have to be related.
Nope.
No.
I've seen self-managed with business partners because they bought a property. So you and I might go into business and we not even business, decide we want to do a venture together, and we could put our supers together into a self-managed fund and go and purchase a property or do something. Yeah. Don't have to be related.
And also they have their own separate account.
Yeah.
Populate.
Yeah, so in self-managed is really simple in a sense. It's a bank account. So you see the money sitting in the bank account. Just don't leave it in there, get it invested, all right? But when the accounts come out, Fred's account, Bill's account, what's gone in, what's gone out. You might be contributing $1,000 into the bank account, but the accounting works out that 500 went to Fred and 500 went to Bill, and they run separate accounts. So that there's tears after bedtime in 3 years' time and decide to separate. The accounting is done and we know whose is whose. It's very, very straightforward. Yeah.
You said there is an administration role in the super account
Yep.
management. Who will be that?
Do you guys do admin?
Yeah.
Yep.
Accountants.
Accounting and admin?
Normal accountant,
Yeah.
but we probably have to get the separate auditor to do the audit, so we're not the one who.
So an audit is done to make sure it's all up to date.
Yes, the auditor should be.
The auditor checks that you aren't making breaches.
You're not using your own money
Mm.
to do something.
Yeah.
I think the starting point for monthly fees is $300 only. Monthly, straightforward, zero cost. Set up one, very simple one, about $2,000 for set up one, and then if you need to borrow money, you have to set up a brand new bear trust that's going to be the extra $2,000. So bear trust can cost a bit more.
I usually work on a rule of thumb to say, setting up a brand new fund. I hear what Jerry's saying. Look, worst case is going to cost you $5,000. It's a lot less now. Every year, you need to budget for the fact that it's going to cost $2,000 to $3,000 to have your funded run and administered. Okay, plus your time of picking up the paperwork and bringing it in, because it's an extra. It's another company. It's another trust that's there, and so there's documentation that comes through. And then thousands to pay your financial advisor to give you really good advice.
Yeah, you need one. You need to set up your own super fund.
That's why they set up like the recommending threshold, like the minimum amount. So
Yeah.
That's why otherwise you wouldn't have like
It's not cost effective.
return to pay back what cost you. Right?
I saw. I may know some dodgy characters around the place. I've met them, all right? Don't know them well, but I've met them. And I saw some groups off the Gold Coast, so let's say no more, were encouraging people to set up their self-managed super funds, and these people didn't know what they were doing, didn't have a real good purpose, and they're setting up with like $40,000, $50,000. And it's just too expensive, and your money just gets churned up if you're not doing it.
Sounds like it's more expensive than a retail.
Not necessarily. Not necessarily. So your retail funds have fees, and they're percentage based. Okay? So as your balance increases, so does your fee, because it's percentage based. With a self-managed super fund, they can be cost effective because the more that goes in, it's not necessary that your fees will increase. You still have the stock standard fee, and it's only if your range of investments increase and they require to do more work, does your fee level increase. So, even with, like a fund, with $700 million is maybe 3, 4, maybe pushing 5
Right.
for cost. It's cost effective. Yeah, it's a flat structure.
Plus, like more than 60% of retail funds like are underperform. I mean, there's a lot of bad ones. Yeah. You know what I mean?
Financial planner, don't trust anything. Yeah.
Probably the other thing I want to ask you is insurance.
Yeah.
Most of my clients didn't buy enough insurance outside super. I only think because in the last few years I've been personally been to some of my clients' funeral. Some of them been very early, 40, early 40, some light one, early 50. Go to the funeral, quite shocked to see how the family been parent and all the costs have been changed because it's so income source, self-employed, didn't pay super. Things happen like that. So I just try to understand what the terminology or the wording on the super fund statement. If I want to check, what should I see? How much I can receive if something happens?
Righto.
Yeah.
So, insurance. There are 4 main insurance types in my world. Life insurance. So life insurance pays a lump sum upon death or diagnosis of a terminal illness. So it's there it pays a lump sum, it pays, all right? And it pays on terminal illness, unfortunately, because I've got a number of clients where we paid on terminal illness. They're having a good time, thank you very much. They're on a cruise somewhere in
Vegas.
Yeah. So life insurance. The second one is total and permanent disability, which is usually shortened down to TPD. So total and permanent disability pays a lump sum if you are totally and permanently disabled and unable to work in an occupation that you are educated, trained, qualified in. Simple terms, think vegetable. If you get hit by a truck and not killed, and totally disabled, total and permanent disabled payment. Okay? Difficult to get paid out, but it's there. Those two are quite often found in super funds. So if you started a job and joined Sun Super or joined Q Super or something like that, quite often there's automatic acceptance in there, and you might have some life insurance and some total and permanent disability insurance. Okay? The third type of insurance that you may have inside a super fund is income protection. Inside super, it's often called salary continuance, or TTD, which is a bit dodgy when you read the policy. So income protection is if you have an accident, an illness, or an injury and are unable to work, it will pay you about 75% of your stated income. So if you've got a retail super fund or an industry super fund and you're going through your statement, if you look for a death benefit or a disablement benefit, it will show a lump sum amount, and that's usually what the insurance component is. And the income, if you've got income protection, it might show as income protection or SCI, something like that. So some have them, some don't. Super is a good option for your life insurances. So if you want to protect family and friends, if you want to clear debt, then you should have your life insurance funds there to clear debt, leave funds to the family type thing. A normal life insurance premium is not tax deductible. Okay, so you'd have to pay that out of your normal cash flow. However, a life insurance policy and a total and permanent disability policy can be held inside a super fund. So whether it's an industry fund, whether it's a retail fund, we can have policies in there. You can also have it inside your self-managed super fund. It used to be the case that self-managed again was good because we could go and buy a really good retail life insurance policy and have it deducted from a self-managed super fund. But these days, in the last couple of years, it's changed. So now I can write you a life insurance policy from any of the 10 good insurers out there in the marketplace, and we can have that deducted from your super fund. All right? And you get a 15% discount by having it rolled over at your super fund. All right? The downside of doing that, two things. One is, if you don't make extra contributions, your insurance premium is reducing the balance of your super fund, and if you don't watch it, your balance could run out. Okay. As we get older, insurance premiums go up, super balance goes down because it's eating into that. So you've got to watch that. The other one is total and permanent disability payments. We start getting technical. There's a superannuation description, and then there's an insurance description. Okay. So the insurance description says if you are injured, unable to work in the occupation you're trained in, they'll pay. Super law, so if the policy is held inside super, what can happen is they'll assess you and say the insurance company says, yep, we'll pay. So it pays inside the super fund, and the super fund says, hang on, are you totally permanently disabled? Yes, but not really by super law, so the money's held inside super. I first had that happen to me, well, not happen to me, I found about 15 years ago. I met a lady who'd had a car accident, and she had insurance inside her super, and she was a seamstress, so she sewed and needed both arms, and she lost an arm in a car accident. So she had one arm, so she could still work.
Technically.
She could still work. So they paid, but paid into a super.
Yeah, but it's arguable.
So does that mean that it would be good that we actually buy that TBD insurance under your personal name rather than the super fund's name?
Well, if you've got a really smart financial advisor, you can kind of split it.
Yep.
All right. So we do what's called this kind of split policy where part of the policy is held inside super, and part is it's held outside of super. Okay. So in the event of a claim, again, it's assessed. Yes, vegetable, no worries, paid. The policy held outside of super is also assessed. I said, does this meet the criteria? Yes, it does. So we'll pay it. So we pay it outside of super, so you get the money. How does it all work? So 80% of your premium is paid inside super, and 20% you pay outside super in your own cash flow. So you it gets around the fact. So yes, we can hold life and TPD inside super, and then we have this split policy where a small component, it's like $100 a year, you pay outside of super on a, say, $1,000 policy, and that covers it, that clears up that kind of thing. Yeah.
Recently I found out that most of the retail fund, industry fund like Sun Super and those people, they normally just like that, what you're saying, that they only pay to the super.
Only pay to
not
super.
the personal.
Yep.
Yeah, that's why there's a lot of people they're still holding like one in a specific super fund which actually can, put it in their personal contribution to pay for the super.
Yeah.
And then the other one is more like deductible in the super.
Yeah. Part of what I do with a client is we look at the whole situation, and when we get to the contingency area, so we're looking at what happens in the contingencies. So we look at the insurance and says, okay, what have you got? Oh, it's all right. I've got XYZ industry fund. And I look at the policy and I read the policy and I check the policy, which I already know, and I can probably quote it to you back to front. And I know that it's not as good a policy as the 10 retail policies out there in the marketplace. So what we tend to do is we get the people insured, we get it underwritten, get a new policy in place, and then their premium effectively gets deducted from the super fund. And once we've got that in place, we then go to the industry funds, they cancel, remove.
Yeah.
And so you get the new good quality insurance policy in place, and it's still being deducted from the same super fund that you've had and loved and want to keep for some strange reason. Yeah. What else can I tell you? Heaps.
So, financial planner, why or when we should fund a financial planner?
Why would you have a financial plan? If you want... No, look, people often say, oh, I'll come to you when I win lotto. That's fine. I've got a plan for that. My job is to make the difficult things simple. Or if you are time poor, if you're busy in your business, building your business and doing stuff, and you haven't got time for yourself, that's what I do. So I'll look after your bits and get them and get all the ducks in a row and get it working so that you can get on and do your work. My knowledge is really broad. Like I came through 20 years of banking, so I've seen everything. Right? I've sold them up, I've given them money, I've cracked heads, been nice, and now I'm out in the retail world, and we provide advice and guidance. We prepare strategies for people saying, how do I get from here to there? Or I'm already there, what do I do now? Okay. So I provide information. Information that you may have, but you may not have implemented. So it's all about helping you get to where you want to go, helping you make smarter financial decisions. Yeah, I think.
Which including insurance, superfund,
So, yeah.
investment, stock.
Insurance, superannuation, investments, estate planning. If it starts with F, we do it. Yeah, it's really broad. Children's savings accounts, share trading. Yeah. Ask me a question. If I don't know it, I can find someone who does it for you. Yeah. And it just depends on what guidance you want. You know, for some people we set up a budget. For others it's about, you know, how do I get more into super? For others it's, I'm ready to retire, I'm worried about what I'm going to earn, how much have I got? For others it's, I haven't got any money. Where's it all going? Simplifying things, restructuring things to make things work. Tracking down 5 lost super funds and putting them together and tuning up your accounts, tuning up your investments. What I'm not is I'm not a stockbroker. I don't give you tips. I don't. You know, that's, I could tell you some, but you know, I'm not about what's the next best thing. I've realised I'm dull and boring. Okay, and dull and boring works. It's like the best investment is time. So if you've got 1 year, we've got difficulties. If you've got 2, it's getting better. 3, 5, 10. If I've got 10 years, I can do a lot. Any more than 10, it's great. It becomes really easy. So it's about providing you with the tools to help you improve your financial well-being.
Can you give us a ballpark figure on the fees and ongoing things such as?
Depends.
How
much you got?
No, I'm talking about,
how
let's
big's
say
your checkbook?
we see for the first time the initial consultation, and then of course from there it's what you want to do, consolidate these and buy this and that.
Yeah.
So what are we talking about? So initial.
For clients of Leader, I generally do my first meeting is free of charge. Okay, so it's a discovery meeting. I get to see what your situation is. You get to hear from me. If I can't do something, I'll tell you. If you don't like me, you can walk out. And that's important. It's important because ultimately I'm in the business of trust.
It's a long-term thing as well.
You don't know what I can do. So I have to be able to provide you with a roadmap of where we're going to go. So from a cost point of view, yep, I'm having a bet that I'm going to spend an hour of my time that I may not get back. Right? At the end of that period of time, I can give you an idea that yep, there's something we can do. What we do from there is I would then, if you wanted to proceed and do work with me, I prepare what's called a statement of advice, which outlines, this is my strategy, this is what I think you should do. That's when you pay. Okay? So I want to know I'm going to get paid, so I'll give you an outline of what I expect it to do. In a broad sense, if it's just one strategy, it's about $500. Okay? If it's multiple strategies, it could be $5,000. So it ranges based on what work's involved, what advice is involved. If you come to me and want to talk about self-managed super funds, it's the upper end. Because it's a lot of discussions, there's a lot of work. We do a lot of background stuff for it, and yeah. So.
How about those clients who just want to look at their existing super?
Yep.
And probably look at their existing life insurance
Yep.
policy? Just about these 2 basic
Just have
services.
come on in and have a chat. Yeah, it's like that initial meeting, it's a discovery meeting again. I can see what's there. I can give you an indication of whether there's something I can do, so it's not going to cost you anything for being there. If you want something to do, again, if it's just one super fund we're going to change, it's in that lower end of costs. Yeah. Yeah. Life insurance stuff or insurance stuff, we still get paid commissions by the insurance companies. So it doesn't matter which insurance company I go to, I'm going to get paid about the same amount. So that's it. We disclose it. And that statement of advice I provide you with outlines everything. We've got clients that realise, and I realise, that we need to do some regular work with. Now that might be for 12 months, or it might be for 2 years. So we would negotiate with you about what that would cost to have, whether it's a monthly meeting, whether it's a quarterly meeting. In most cases, my clients come in every year. We'll report to them about every 6 months, but I want to see them every year. And we find out where you're at, what you're doing. Or before you come in, we'll get information of all your bits and pieces, and then we can just figure out where you're at, what's changed, what needs to go. What are your plans? Do you want to go travelling? You want to buy another house? Let's put those strategies in place. Want to buy a red Ferrari? Don't think that's financial advice, but we can do it. We can talk about it. Does that help?
Yes, thank you.
Yeah. All right.
Thank you, Andrew.
We've got some gifts too. Yeah. These are. Make sure everyone takes something home. So there's lots of little gifts here, little gift packs. All in my industry, there are product providers, fund managers that always want to come and see me. So these are little gifts that they've put in. So we thought, well, why not give them to all of you?
This for you. All right, thanks, Andrew. I think just hopefully everyone got information. Do you have a card in the?
Yes, should be a card in there.
Yeah, just make sure you mention before you see Andrew, we got first meeting free, so quite a good deal. Yeah.